to a wine bar that, welcome everyone. Dawn and Dan here. We're just talking about current events and the market and how you can create income and protect and grow your investments in any market. So we're so happy that you're here with us. And Dan, right? We were just speaking about things seem to be loosening up here in San Diego as it relates to businesses opening. I was at a wine bar last night. They had live music in Oceanside here in California. Are you seeing signs of life down there in San Diego?
Yeah, it's like nothing ever happened at this point this weekend. Downtown was packed. Everything was full. I'm letting the gerbils go first and see how they fare.
Yes. Yes. I get it. Yeah, I mean, we're still keeping our distance, and crowds are not my thing anyway. I do not like crowds. I don't go to big stadium concerts anymore. You know, me doing crowds, that's a thing of the past. You know, I'm a Jersey girl, so I remember going to see Bruce Springsteen at the Meadowlands and, you know, going across the highway like a herd of cattle, and those days are over for me. Those days are over for me. So as always, Dawn Doherty, Dan Gasparini, I'm the option seeker. He is the options guru. And we get together every Wednesday to talk options, to speak about what's going on in the market, how we're discovering income, what we're doing in our long-term portfolios to turn up the rate of return. And I just have some simple things to share with everybody today, mostly like questions around when to take a trade and when not to take a trade, right? Don't you feel, Dan, that's the biggest question our students have when they work with us?
Yeah, you know, it's sometimes difficult to know like exactly when to pull the trigger on something or when to manage it, for example. But yeah, no, totally agree.
Yeah, and a lot of it is analysis. Also, a big part of it is gut instinct and knowing yourself and your tendencies and your risk tolerance. So that's a big part of it as well. We call this Options 101 because many people who come to this call are options curious, right? Wouldn't you say by the time they come to us, they understand that options are safe, options are exciting. Perhaps they've read a book or two or looked at a webinar, and they just want real people that they can come to who are making real profits, who will really take the time to get them and also, you know, have their back. So that's what you and I are all about. How would you put it in your words?
Yeah, I mean, when I first started trading options about 10 years ago, you know, you learn pretty quickly that this is very difficult to learn and pick up just on your own, you know, via YouTube videos or books or, you know, trial and error. Right, that's the most common one. But what Don and I wanted to do was provide a group in an area for people to have that hand-holding and, you know, guidance, especially early on in their trading journey. So that's what we're here to do.
Exactly, and it's really exciting. I wake up every day so jazzed when I hear that bell ding, ding, ding going off at 6:30 in the morning. It's very exciting for me. And what's wonderful about options is you're not tied to your computer. You're holding positions, usually, definitely 99% of the time, more than one day, 99.99% of the time, more than one day. You know, we're usually in positions for a week or two. And then every single month, we host a session where we go through long-term portfolios, and I'm really excited about that. I created with my long-term portfolio mentor a diversified portfolio of exchange-traded funds. And I have a strategy for turning up the rate of return through selling covered calls. And it's very exciting, especially in times like today when there's a lot of uncertainty. There is a way to turn up your rate of return. And there is a way also to purchase insurance on your portfolio. And this is something that managers, people who go to the Morgan Stanleys of the world, the JP Morgans of the world, they're people who they're paying 1 or 2% to a year. And I know this because I used to do it, are not showing them these strategies on how to protect their portfolios. And they would not have, gone through a 20%, 30% loss, with what recently went on, if their managers were showing them what it is that you and I know. So, very simply, we can buy calls and buy puts to look for simple buying options. Dan and I go into verticals and other arrangements, but very simply, options can replace buying high-priced stocks. If you feel that you want to take advantage of a Tesla move or an Amazon move, there's a way to do this without shelling out over $2,000 a share times 100 shares. Most people don't have that money inside their portfolios to take advantage of moves that are going on today. So legal, we are not financial advisors. If you have any doubt or if you have any questions regarding what it is we're presenting today, please seek advice from an independent financial advisor. So we just want to put that out there. You can read this disclaimer, and boom. How to make money in uncertain times. I go over this every single week. Let's take what this market is giving us. Many people are on the sidelines and not taking advantage of what this market is giving us because they're fearful, or they're buying and holding. They're in, this old strategy that just does not work today. Buy and hold does not work in this market. Buy and hold, I believe, was something that worked very well at a previous time when, the market was surging, right? Between 1980 and 2000, the S&P 500 was up 1,400%. And we attribute that to, so many people getting into the market because companies stopped paying pensions, and it was, their responsibility to take over their retirement management, right, through IRAs and the mutual funds that their companies provided in 401ks. So now volatility gives us movement, and we can be assassins. We can hit and run. And Dan, I want to talk about the SPX butterfly that I put on last week. We were on a call and you suggested a butterfly on, and we'll talk about what that is. I have a picture of a butterfly in my presentation, on the S&P 500 index. And in a very short period of time, I think it was less than a week, I collected $2,700 in 1 week. Crazy.
That's a good return. I mean, to give them an example, what did you have to tie up in a play like that?
Yeah, so I'm on a play like that. I think I was tying up something like $5,000. Mm-hmm. And when I say tie up, that doesn't mean what I would have risked. It's just, what your broker wants to hold as collateral. That's a good way of looking at it, right? Mm-hmm. For the particular trade. But we were risking, I'll pull up the trade to show you what we were risking. Very, very, very low, just really what I paid for it. Right. Yep. So I know I paid not all that much. I think I paid like I don't know, $1.40 or something for it per contract. So this is what we show you. Options are fun. People who are learning with us are ecstatic. And what I love about what we do is we really hold people's hand, and within 2 months, they're taking trades on their paper accounts, which is, your Monopoly Money account, or you could set up a free paper account with Thinkorswim, which is owned by TD Ameritrade. But you can do exactly what Dan and I are doing in this workshop together, right? So let's continue. Shopping when things are on sale. I just gave this example because many of us are following Zoom. You and I are on Zoom today with this call. Zoom became a darling of the markets recently because everybody's using it for work. And I do believe, I was on a call with somebody yesterday who did a lot of trading did a lot of traveling for his work. And when he would put on workshops, he would spend $2,000 per workshop. He said, I'm cutting my expenses and I'm doing virtual workshops now, and they're working better than my travel workshops. I held workshops, with you and with my other partner, Lou, and we had, at our largest workshop, we had 80 people on a Zoom call from all around the world. So Zoom really opens up the borders of who you can reach. Plus, it offers this comfortable alternative to facilitating meetings. So I just looked at this because I know we have our dear Brit on the call, and she I think she even sent this earlier. She said, there was a piece on Zoom over the weekend regarding security, and you can see Zoom was as high as 181, and this is a 180-day chart that we're looking at. Today, Zoom is about at 155, and you and I do our technical analysis. One of the things that we look at is the Fibonacci retracement, and that's what we're showing right here, the Fibonacci retracement, and we show the various from 0 to 23, 50, 78. This is a natural pattern. It always blows my mind, Dan, how this shows up in the financial charts, how this pattern shows up in the financial charts, right? Cool.
Yeah, that long tested and true pattern across numerous places in the world, in the universe, in the layout of a flower, and the human face, and the financial markets also.
Exactly. So what this is telling us is Zoom pierced the 78% line there today. It went below it. I think it's sitting right on it. I'll tell you what Zoom is like right now. Let me see. Trade. Zoom is at 157. So now we're back in that, that's between the 78 and the 100. All right. So let's say I wanted to look at a trade here. I was looking at the previous Fibonacci, which, we have at the previous pivot here was about at 132. You see that pivot right here, 132, and right in between the 50% and the 78%. So I was just, I was just looking at what would that be like to put on a bull put spread. So a bull put spread means we are selling a put contract. We are selling a put contract, right? And we're protecting it. We're selling to open. We're a net seller. So I was just looking at the June 19th, and I was looking, if I were to look at this chart, I would say, wow, I'd be comfortable with Zoom staying above 130, protecting ourselves, should it go down to 125. And when I looked at this trade, there was a dollar credit. So a dollar credit. So as long as Zoom stays above 130, we profit. The max loss on that, meaning, the most I can lose, is the difference between the 130 and the 125, which is 5 times 100 times 10 contracts, which is 5,000, minus what I collected up front, which was 1,000. So I looked at this 25%, as long as Zoom stays above 130. So I would just like to know, and maybe Dan, you could look in the chat, would you take this trade? Would you take this trade? Max loss 4,000 if Zoom goes below 130, and the upside is 1,000 if it stays above. And we have a lot of people on Facebook watching us too here live. So yeah, share perhaps, would you take this trade? Dan or Britt? Britt's on the line.
I mean, in analyzing it right now for the first time, I mean, it seems like with the resistance at about 130, it would make sense.
Yeah.
It was what a 19. It's roughly a 21-day trade, right? So you're banking that price stays above 130, right, on this chart for the next 21 days, and if it does, you make $1,000.
Right. So
Sense?
25% optimally. Of course, we take off our trades if we are more than 50% close to the max profit. So if we're, in this case, $500 or more, if we're profiting $500 or more, within the first 2 weeks of this trade or so, we take the money off the table, right? Now, let me show you something a little bit sexier. I'm getting spoiled, Dan. This isn't sexy enough for me.
Okay.
Like I'm looking at, for when we look at verticals, a lot of times we have a bigger payoff than this, but certainly this is a viable trade. Would you agree with me?
Yeah.
Yeah. Yeah. And I just wanted to show that because most people on the line here who are watching us know this, know Zoom. Look at the chart. The lows are higher, and until recently, the highs have been higher, right? Until recently, the highs have been higher. That recent high was just a little bit below that 185. So I was just playing around. I haven't put on any of these trades. I want to, be straightforward with this. Last week, Dan, we talked about butterflies, and I'm falling in love with butterflies. Butterflies made me $3,000 this week with the SPX. So I'm falling in love with a butterfly, and all a butterfly is, as you showed us last week, is two verticals smushed together, right? So instead of this being a credit that I'm collecting, it's a debit that I'm paying, right? So here's an example of if Zoom by expiry comes in within the 120 to 140 range, with a little bit off of there, because of course we paid 35 cents here. So we're taking 35 cents off the 140 and we're adding 35 cents to the 120. If we stay within this range, we're profitable. And this is a lot sexier because if we end up here at the point at 130, max profit is $9,600. Is that a little bit more exciting?
I think so. I mean, that's also a great way to work in conjunction with your other play.
Yeah.
Right. Where you say, on one hand, you say, I need price to stay above here. But on the other hand, you say, well, if it does go below there, I can still make money. We'll talk about later. We'll talk about in the future, working plays together that are, they have a synergy, right? They're built in a way that they protect each other, right? And so to your point, like this would go very well with the previous trade you had on.
Yeah, and maybe even combine them, as Dan was just saying. And certainly we could look at other ranges. We're looking for low risk, high reward. And, in this particular situation, we're only risking $350 with the potential to make $9,600, albeit it's a smaller range there, and it's a different pattern. But this is what's so exciting about options. I have Dan knows this, I have a lottery ticket on right now on Tesla. And by the way, Tesla's been moving up. And my lottery ticket, I'll just take a look at it, on Tesla this is a trade that I have on, that if Tesla gets between 870 and 880, by June 19th, Tesla is currently, it's down today at 806. I don't have much in on this trade. I have $900, tied up. That's my max loss, $900. But at a max profit, I'll take a look at this. This trade is $40,000. $40,000. So options are fun. You could do things like this, but there is steady earning, and there is a way to turn up the rate of return of your long-term portfolio. I just say that, to share how exciting this is and the possibilities. So I'm going to hand this over to you, Dan, now, and we'll talk about this. This Friday, we're doing a special session that, and we'll go into this, that is free from noon to 3 p.m. All you need to do is go to optionsforwealth.com and sign up for this. And we're going to take you through what we show our students and give you a taste of how you can start making options work for you.
Yeah, I highly recommend even to our current students to attend that.
Yeah.
Repetition, right? That's the key to this.
Practice, practice, practice is how we get to Carnegie Hall, right?
Mm-hmm.
Okay.
All
And
right.
I'm handing it over to you.
Let me share my screen here.
Cool.
So I was going to go into butterflies also, but I can instead just touch on some of the trades that we put on a few weeks ago and do it that way.
And also we have some people asking for our emails, so I'm just going to type them in the box. Dan and I welcome your questions either here or if you want to pose them to us privately. I'm just going to put it's Dan at Options for Wealth and Dawn at Options for Wealth, right? Cool.
So here's a trade that we put on. It's a simpler one. It's purely directional. But this is something that we put on in March, I believe, end of March. So a bit of a longer term position, but it was on Mercury General, right, which is primarily a insurance company. And when we had price falling and falling right through March here, and I believe we entered the trade somewhere in this, kind of jumbly area. And what we did was we bought calls at 40. So let me put a line on the chart here. So if we bought, quick line, we bought calls with a strike price of 40 with an expiry date of June 19th. We bought 15 of them. Okay, and we bought 15 of them for an average of $1.30. So what that means is we paid $130 times 15, because we bought 15 contracts, and that we would be profitable so long as price increases past 40, which was our strike price, by June 19th, which, as you know, we're not there. We're not at June 19th yet. This trade is still live. And it has increased past.
Amazing. I remember when you put that on, and the thinking there was auto companies are not paying out on accidents as they were previously because everybody's staying at home.
Yeah, exactly. So it was a more of a fundamental type of play where, the business model of an insurance company is to just collect. And if people aren't driving right as much, which, as we know for the last 2 months, they haven't been. I see pictures, like I go on this website and it shows pictures of like the major highways in LA and San Diego at rush hour. It's like, man, I wish it was always like that. There's like hardly any cars.
Oh my gosh, there's no traffic around here. Yeah, I did a same move on GE recently. I just bought 10 contracts, calls at 47 cents a contract, okay? And at the 6th call, and GE is right now at $7.33.
Yeah, so it's a good little trade. So to give everybody an idea of the potential earnings,
this is what I love about this.
On a trade like this, right? So as it stands right now, my current P&L, current, I'm up $1,110 currently. But the good part of this trade is, because that's good money, but like it's not great money. What we're targeting is an area somewhere in this zone, either in this area here, which is a minor resistance level, or best case something way up here, right?
Yeah.
And the reason why we're targeting those areas, right, is this is when the market. This was the original area the stock was trending at.
Yeah.
And remember, it was trending here for a while, right? It wasn't just.
Yeah, I would say we looked at the fundamentals too at this company, of this company. So the earnings per share, sales revenue, So, this is a healthy company.
And sometimes you can always just take a step back and say, go out to maybe a daily chart that goes out a year back in time and just look at a chart and say, like, is this high or low right now? Like, just as simple as that. Like, is this high or low right now? I mean, to me, like, this looks pretty low right now.
Mm-hmm.
Not saying it's going to get back to 65 anytime soon, but I think that this area is more than probable. 45. I think this is our higher end profit target is maybe 55. But because we have 15 contracts, okay, and we just got in the money, so we're in the money now, right? Because we bought our calls at 40. Every dollar it goes above now, we make $1,500 because we have 15 contracts. So if
every dollar, can you say that again?
Sure. Every dollar above 40 that MCY goes to before May 19th, May 19th, I don't know.
June 19th.
Before June 19th results in a $1,500 gain.
Amazing.
So, if that's 45, that's a $7,500 trade. That's 55. That's $22,500 trade. Am I doing that right? 15 times 25 times 100 is.
Yeah.
Let me backtrack a little bit. 15 times 25.
1,500. Yep. That's it.
Anyway, sorry, it's 15 times 15 times 100. My mistake. Yeah, 22,500. So I mean, that's the type of thing that we like to set up and do. And remember, so my total cost on this trade was 130 per contract, right? 15 contracts, so $1,950 was my total cost on this trade, and it has a reasonable certainty at this time of making, I would say at least 2 times that at this point, given that we continue to rally. And third of all, how we made money on the same trade was that we sold calls against it during the duration of the trade and collected an additional $750 in premium from selling the closer calls against it. And that's called a diagonal play. And we've covered diagonals in the past. I don't want to go into a ton of theory on diagonals right now. It's more of like a middle to / advanced technique that you would do, but regardless, many ways.
I'm going to just jump in here. Doing a diagonal is really reducing the cost of your call over time. So, this play, and I'm not going to get into it here, but there's something that I was going through yesterday with synthetic options, where instead of buying high-priced stocks for long-term profit, you could use this kind of same strategy. And if you're buying, in the money strikes that you feel really great about, you could reduce your cost through selling shorter-term contracts, and that's super exciting, and that's what we take our students through as well.
Yeah, like to give you an idea, right? Like these calls were originally $2.72, and I've reduced my cost down to $1.30 per contract by selling calls against it,
right.
Which have now expired worthless, right? Which is what we want to happen.
Yes, we like that. Putting money in our pocket every month. Selling, when we sell contracts, we're collecting premiums.
So yeah, and some of the things, like we'll touch on these in like the breakouts for the class we're going to do on Friday, but the basics is what we're going to focus on. We like to use these Wednesday sessions as more of a hey, look at this trade we took, hey, look at that trade we took, and talk about it, right? But I mean, so understand that this is not designed, right, to have you guys attend for an hour and walk away with, great, I'm going to go put on a diagonal, I know exactly how it works, right? But that being said, the Friday classes are designed to give people at least a base level idea of directionally operating within this grid here, just buying and selling puts and calls. And for our students that are with us on Mondays, Again, we strongly encourage always to attend, because the repetition and the hand-holding and the aha moments are always there. For every time that you spend additional time learning and trading and interacting and speaking this language, what we're looking for is just that one or two nugget takeaway experience, right? For our students and for new people joining us. Anything to add to that, Don?
I'm just excited to see the people who are on with us today, not only here, but on the Facebook Live. And hey, let's get real. This is a new normal that's not going to go back to where we were. Many people who work for corporations, their salaries were cut by 20% or more. Many people were laid off. I'm speaking to a friend yesterday who's collecting unemployment. She's reaching out, trying to get jobs, and people are saying, the jobs that you're applying for, we're not filling those jobs anymore because of what, just went on with COVID. And it's your responsibility to create an income stream and protect your long-term assets, for yourself, so you could sleep at night, for your family, for security. So this is really why Dan and I are doing this. In our heart of hearts, we know that there's so many people out there who don't understand how the financial markets work. And if they learned this skill, their lives would open up in so many beautiful ways. So just looking at it from that perspective, and then layering on how fun this is. Sometimes we look at a chart and it may sound dry what we're taking you through, but really this is super exciting and super fun. And most people in this world don't understand what it is that we're showing you. And that wasn't meant to be a sales pitch. I just want to give you a wake-up call. If you don't have a plan B or a safety net to fall into as we shift through whatever we have ahead of us, you're always going to struggle. So just show up and see if it's for you. Sometimes we learn things and we decide it's not for us, right? So I love to knit and crochet. I took a quilting class. Quilting is very difficult. It's very precise. I'm not a precise person. I'm a free form person. I have such a great appreciation now for quilts. I know I'll never do one. At least allow us to help you facilitate a decision around whether or not you want to learn more about this. And Britt's saying it's fun, it's a good plan, and you get options brain. I feel like I'm smarter, I'm sharper through doing all of this. My options brain clicked in. So
going back to school.
Yeah,
in a good way, though.
Better.
Not in a bad way. We do give homework.
Oh my gosh, I just shuddered, thinking about the nuns at St.
I like
Vincent de
school.
Paul.
I don't know.
Show us more, Dan.
Yeah. So just like more of a macro commentary. This is a Fibonacci drawn on the SPX, which would look the same as the ES or the SPY. But essentially what this is, a basket of 500 biggest companies in the US, right? Amazon, Apple, Microsoft, they are all blended into this number, okay? And in what we're seeing, what I'm trying to express here, right, is that we fell from a high, in this case of 33.93, down to a low, substantial fall down to 21.91, which is, roughly, I want to say about a 40% fall. Okay, very quickly. Okay, we paced the 1929 crash in the velocity of that fall, and we've since recovered, and we're a little bit choppy, but we're recovering. The area I'm most concerned with on this chart is this 76.6% retracement for three reasons actually. Number one, it's a powerful Fibonacci number. The 78.6 is one of the more powerful areas of points of inflection, right? Number one, which means that it's likely to turn back around there for that reason, number one. Number two, we see a very strong resistance level here where price originally dropped, right? Rebounded swiftly, hit that 78.6 and fell off a cliff. That's number two. Number three, a lot of people don't know this, and the data in this chart doesn't even go back this far, but in 1929, the exact same thing happened. The price took a big beating, recovered right to the 78.6 percentile, and then moved into full recession mode for 5 years, 5 to 6 years from there, and then slowly recovered toward the 40s. So, you know, we really need to understand that the fundamental, like, impact of this virus is not baked into the long-term economy at this point, right? You can only print money for so long. Now, that being said, bigger picture, the US should fare better than most countries because we are as many of you know, the fractional reserve currency, meaning that all futures contracts are settled in US dollars around the world, meaning there will always be a demand for US dollars. But that being said, big asterisk, big, you know, this is the number, right? This is the number that
3136. Write that
really
down.
watch.
Write that down, everyone.
And so as the weeks go by and as we hopefully trickle back up here, you better believe we're going to be probably taking some very short, very bearish positions as we approach this number. Not to bet against, not to bet against the economy and the American worker and all that, but you know, we're here to make money. So
and what does this mean to those of you who have stocks in your portfolio? Let me talk to you about that. And this is what we're going to show you how to do. So here you are. Some people, you know, just are going long for the most part on blue chips. Perhaps they have Coca-Cola, perhaps, you know, they have Caterpillar, blue chips, right? IBM, Goldman. So your financial planners tell you, well, look, it's recovering, feel good about this. Some people will set stop losses. Now, stop losses are not guaranteed to take you out, especially if there's a crazy, you know, gap between when market closes and when market opens. So one of the strategies that we introduced to you is a strategy that pension funds use, which is selling a call for contracts for every 100, you know, lots of 100 shares you have a particular equity or ETF. And then you can buy insurance for less than what you collected on that call. So you're actually being paid to protect your portfolio should it go down below a specific level that you set for yourself. And gosh, I wish I knew that strategy in 2001. I wish I knew that strategy in 2008. And it's a strategy that I'm using right now. And it's something that you all should have in your back pocket, especially with what Dan is showing you. We're not showing you this for you to like shudder or, you know, shake in your boots. We're just showing you this. You know, if I were to tell you that there's, you know, bad weather coming and you were going to a rock concert, you would take your poncho, right? You would take your rain poncho with you. This is the equivalent of that. So be smart, have your finger on the pulse of what's going on rather than, you know, listening to people who, God love them, they just want to be bringing in more and more money and collecting that 1%, 2%, whatever it is that they collect by just keeping you steady. And that's my little soliloquy on protection, right?
yeah, I mean, it's pertinent now more than ever, right? I mean, there's two ways to look at it, right? It's like, okay, I'm gonna protect, right? I'm gonna make sure that I'm gonna be long, right? I'm long the US, I'm long the market. I got my 401k, I got my IRA, it's all in stocks, ETFs. I'm long. But just in case, maybe I'll buy some insurance. And you know what Don was telling you, that's probably the best way to buy insurance, right? Believe it or not, you can insure your portfolio the same way you insure your car or your house via doing this. Number one. Number two is almost like I always like to use a baseball analogy because I played baseball in college and all that, but if you're up against a pitcher and the pitcher is the market and they have some tell when they're going to throw a curveball, you just sit back on it, and when it comes, you just knock it out of there. And that's the other way to look at this, right? Market movement presents massive opportunity, especially for the smaller trader, right? Remember, the advantage that we will always have as smaller traders versus the big, $100 billion hedge funds and whatnot, the advantage that we have, it's weird to think that we actually do have an advantage, right? But the advantage that we have is we're nimble, right? We can get in and out of these positions. They can't, right? If they need to dump, $20 billion worth of Facebook, they can't do it all at once, right? Especially in options, because options are leveraged. Once you get to above about $100 million trading options, like, hey, I hope some of us get there, but we probably won't. But for the most part, like, that's not a very big fund. $100 million is not a very, very big fund. Okay. And a lot of the strategies that we're doing can't really even be utilized with that amount of money because there's too much leverage built into them. So this is a market that exclusively we are able to really hone in on and take advantage of as the retail trader, right? And it's again, like this was a major takeaway that I had, especially in the beginning of trading, is like, I have an advantage? What? But really, we do. Anything you want to add to that,
because
John?
we've been we've been brainwashed to think, like, there are some people that think, oh, we can't, we don't have the advantage that they have. Their orders get filled first, right? And what we're telling you is that's when you're looking at the scale of who they are, that is not the case. And platforms today are so much more advanced. We're showing you think or swim. I get filled at a mid. I place limit orders as you do, Dan, and we look for our price rather than just taking market. And these are all things that we're going to talk to you about on Friday. So I think more than ever to join Friday's class, I'm going to give you an example of what that looks like, how to buy that insurance and how to get paid. This is the key thing, how to get paid to buy insurance. It's not costing me anything the way we set it up, because we're actually selling a call contract that's higher than the insurance that we're paying should our underlying be, hit by what we're anticipating on happening, right?
Yeah, and fun fact, when we did this 2 weeks ago, I made $1,000 in front of everybody in 3 hours live. So,
Yes.
Come tune in just for that alone. Hey.
Watch Dan make money. So yeah. I would just love, we have a lot of people watching us on Facebook. We have people here. It's 10 to the hour or so. Does anybody have any questions, or would anybody like for us to pull up any index, any ETF? Dan, why don't you pull up GLD for us, which is the gold ETF, right? So we saw a new high recently. So let's take a look at that. So I've been looking today at GLD, and let me tell you what I was looking at. Okay. Let me just look at that. Hold on for 1 second. Always interesting. Okay. So let's draw the Fibonacci there from the 164, maybe from, yeah, cool. So if we look at this, and let's say I'm bullish on gold, right? I'm bullish on gold. Would it be fair to say that I'm at the 150? I'd be pretty comfortable with a trade where I'm staying above 150, right? For, let's look at maybe the next contract or so. Would you be comfortable with what we're seeing on the Fibonacci here?
Buying at 150?
staying above 150, bull put spread. Right? The 150 is the 50% Fibonacci.
I would almost put it like here. Because that way,
147.
yeah, I'm sure there's a strike at 147.5. But,
Okay.
you know, because then if it hits the Fibonacci and it bounces off rather than hitting the Fibonacci right where you're about to go in the money, it's a little scarier. You know what I mean? Give yourself
So
a bit
let's
of
look at what the credit would be there for selling the put at 147. Yeah, it's just something I picked up on today that, you know, where would you go? June 19th?
Yeah, go to the quarterlies. I mean, like when we're selling options, we want to try and stay above 30 days because between that 30 to 45 day window has the most rapid depreciation relative to risk. On what do we say, 140?
Where 147? Okay. Remember, optionsforwealth.com. People, join us this Friday, free, 3 hours. And it's an exciting class. We do breakouts. You meet people from all around the world who love money and who are sick and tired of other people losing their money for them. So income plus wealth equals omnipotence. Really, it doesn't get any better than understanding how to make money in all markets. So yeah, that's kind of a not a great credit there. What does the 150 look like? What does the 150, 145 look like?
A little better.
Yeah.
I mean, there's also, like, you know, gold is typically inversely correlated to the overall market, right? So if you were to go like to the end of the year, it wouldn't be a, let's see what that looks like.
And while we're looking at gold,
yeah, that might be the play to the end of the year.
Let's look at that.
Because, you know, saying that gold is going to stay above a mark for, you know, a month and a half versus to the end of the year, you're going to get number one, a much better return on this. Oop.
Oh, I'm sorry, Britt. It says the May 15th. No, it is May 29th. Yeah, and I'll look at that lead page. I'm sorry. It's May 29th, you know, the class, which is this Friday. So I'm sorry, Dan, I was interrupting you.
But yeah, so here's an example of, you know, something that would be more of a portfolio trade to me. You tie up, maybe, you know, this is like if you want to go long gold, right, till the end of the year. This would be the way I think to do it. Build in a good insurance component, right? You're safe until we go below 150, right? Remember, 150 is a good way away. And secondly, like from a macroeconomic lens, gold is a safe haven, right? Gold is a safe haven. So if the market does tank, gold is not going to be very affected by it, relatively compared to equities, right?
Yeah, and there you are at 150, which is a major support level on the Fibonacci at the 50%. So if you're okay with looking at this chart and with, you know, the election coming up and all the uncertainty around the election with people, we're all watching people, you know, buying bars of gold and what we see in the news. This would be a great way to hedge your long-term portfolio by going bullish on gold in the manner that Dan just shared, by selling put contracts, So yeah, Dan, I'm going to just go through just to wrap this up on our slides here, the PowerPoint around Friday. So optionsforwealth.com, optionsforwealth.com. This we're doing this. We did it 2 weeks ago. I'm not saying we're doing it every 2 weeks, but this Friday, the 29th, from noon until 3. It will be at a Zoom room. We'll be sending you the link to the Zoom room. And we're going to show you how to commit to your number and create a trading and investing blueprint that is aligned with your goals, right? Because not everybody has the same goals. There's a plan for you based on what you want in life. You know, for me, my plan is to make $8,000 to $10,000 a month in income, and to make a minimum of 1% rate of return on my portfolio in any market per month, right? So when you have a goal and you take action towards it, you realize your goal. You realize it. And it happens every time, because what you're doing is you have your finger on the pulse of where things are going, and you're doing course correction. We correct trades. You know, we correct our portfolios, and this is not what financial advisors are doing for you. Again, we're not financial advisors. We're giving you ideas. Options versus traditional trading and investing with stocks, strategies for directional plays, strategies for neutral plays, which we put on a lot of neutral plays, meaning if you want to say where you think price is not going to go, you can profit from that, right? And then everything we talked to you about on how to put insurance policies on your long-term portfolio so you do not get impacted in uncertain times, now more than ever, with the election coming, with the effects of COVID, you know, the potential second occurrence of COVID that they're speaking about in September. Just learn this skill for yourself, for your family, for, you know, your ability to sleep at night. And those of you who know that you want to fast track and just come and work with us, we have a mastermind of amazing people. We have a WhatsApp group where we share ideas. Like this morning, I shared an idea on FedEx, and I just had our group take a look at it and come up with what they would do based on what FedEx was, what the chart looked like. We roll up our sleeves. You have access to world-class training, and we offer one-on-one mentoring at reduced rates. So that's what we're all about. And I love doing this, Dan. With every session on a Wednesday, I become a better investor and a better trader. And it's my lifelong passion to be sharp around all of this, so I can show others that money isn't something that should ever be feared. You know, money is something that should never cause anxiety, because abundance is everywhere, and it's just shifting your attitude and perspective, thinking and growing rich, that everybody has an opportunity around, right? So I'm just going to hand it over to you if you want to say something before we go over and out here. But I'm so happy that we were able to do this together today.
Yeah, thank you for joining us. You know, I hope you can tell we are very passionate about this. You know, I grew up in that world also. You know, went to college to be a financial planner type guy. Learned pretty quickly that this is way too simple of an approach to ever work long term, being that the financial planning approach, right? Gather assets. That's the model. But truly, learning this is a team sport. It is a group sport. You will have questions. You will hit roadblocks. That's okay. That's what we're here for. And you know, with that being said, I hope you join us on Friday.
See you Friday. And Dan, will, as always, just this was so much fun. And I liked today. It was free form.
Yeah, we didn't really have a whole lot planned today, but I think it went well.
Yes, thanks guys, so awesome. And thank all of you for being with us. And if you want to get in touch with us, Dawn at Options for Wealth, Dan at Options for Wealth, optionsforwealth.com for our next workshop. All right, bye now. All right.